In this video, we will look at issuing bonds at a discount. And just to review, remember that a discount is when the contract rate is less than the market rate. What that means is the interest rate written on the bond is less than what you could get the bond in the market. Okay, on January 1st, Coal Corporation issues a $1,000 6% 5-year bond that pays semi-annual interest for $900. Journalize the entries to record the issuance of the bond, the first interest payment, and amortization of the discount at payment of the bond at the maturity date. So because we are issuing the bond at $900, we're only getting $900 for the $1,000 bond. We are issuing the bond at a discount. So January 1, we are getting cash for $900, and I'm going to skip a line and always note that we are going to pay the bond back at the face amount. So make a note that what you credit to bonds payable will always be the face value. And this line in between is always going to be a discount or a premium. And since we need a debit to balance our journal entry, we know that this is going to be a discount. You can remember that discount has a normal debit balance. Remember D and D. If you need a debit to balance, it's going to be a discount. You would also know that because you got less than what you're going to have to repay. Okay, and we know how to calculate the discount. We received $900. The face value is $1,000. So that makes the difference a discount of $100. So the way that I put it in shows this as a negative. So if it's a negative here, then it would be a discount. And then if it's a positive, it would be a premium. Okay, let's move on to the second part. So now we need to record our first interest payment. So we pay interest, semi-annual interest, so every 6 months, and the amortization of the discount. So we need to talk about what that is. So amortization is very much like depreciation. So another way to say that, and how Ms. Bergeron explains it, is it whittles down. So we're starting off with a discount of $100 total. And what we want to do is get rid of it over the life of the bond. So first let's calculate our interest. So our bond's face value is $1,000. Okay, the interest rate is 6%, and half a year, every 6 months out of 12 would be 0.5. So the interest to be paid semi-annually is $30. All right, if you look down here, I'm going to delete this for a second. So we're going to amortize the discount, and if you look, let me fix this. So it's the discount divided by the number of periods. Well, we know the discount is $100. The number of periods, well, we are going to amortize it when we pay the interest. So that's twice a year for 5 years. So the number of periods would be 10. So the amount to amortize, we take the discount and divide it by the number of periods. So we're going to amortize $10 each period. So every single payment period, which we have 10 of those, we're going to amortize this bond by $10. So here's how we amortize it. Discounts have a normal debit balance, so we want to amortize the discount equally over the life of the bond. So every single 6 months, we're going to credit it for $10 until it's gone, until it has a zero balance. And that's what we mean by amortize. So on June 30th, we are going to make our first interest payment. So we are going to start with interest expense. And then remember, we talked about amortizing the discount. We're going to debit credit the discount because it has a normal debit balance. And then we're going to credit cash because we're going to pay out some cash. I like to start with cash. So every single interest payment, I'm going to pay out the same amount of cash, and it will always be the same regardless if it's a discount or a premium. So I will credit cash. I'm going to pay out $30. So remember, to calculate your interest that you're going to pay in cash, you always take your face value times your interest rate times half a year because it's semi-annual. So we're always going to pay them their $30. Okay, the difference is we're going to have to amortize this discount every period. And so I am going to amortize my discount each time by $10. Now, watch what that does to interest expense. It's going to make interest expense $40. Now, it does not affect what the people got. The people got $30. But for us, that represents additional interest expense. And the reason is we sold that bond at a discount. The contract rate was less than the market rate. So for us, a discount means we add that to a discount adds to our interest expense. Okay, so the last part of this asks us to retire this bond at the end of its life. All right, so when we issued the bond, we recorded a debit balance discount and a credit balance bonds payable. So this is at the issuance. So right when we issue it, we can say the $1,000 credit, the $100 debit, the carrying value of this bond is $900. So in the first semi-annual interest payment period, we reduced that discount by $10. And then we did that for each of the payment periods afterwards. Remember, we had semi-annual interest payments for 5 years, so that's going to be 10 years. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Okay, so our balance here, 100 minus 100 would be a 0 for discount. So we have amortized our discount. And so 1,000 minus 0 is 1,000. So now our carrying value of our bond is $1,000. So here's how we're going to retire this bond. We're going to debit bonds payable for the amount in bonds payable, which is 1,000. So we got rid of that liability because we're going to pay these people their $1,000. And notice we don't have to do anything with our discount because it has been amortized. Remember, we amortized it and it moved into interest expense. So just a quick recap here. Here's how we generalize the entry for the issuance of the bond at a discount, the payment of interest expense, as well as the amortization of the discount. And then finally, the retirement of the bond. That's the repayment of the bond at the end of the 5 years. Let me know if you have any questions about this. On the next video, we are going to do the same thing, except we're going to learn how to account for a bond at a premium.